All right. Today is Wednesday, September 22nd, and this is a recap for the stock market activities today. Happy Fed Day. When I say Fed, I don't mean the Federal Reserve. I mean we are Fed kind of day. But let's backtrack here because overnight we got the news from China that the government is injecting over $18 billion into the financial system to mitigate the Evergrande crisis. On top of that, Evergrande also negotiated a deal with lenders to extend the payments due in September to a further due date. All of this is good news for the market, at least for now, soothing the concerns, even though Wall Street yesterday said that our fears regarding Evergrande already faded away. But now we have a confirmation that those fears are gone. Right? But so far, so good. And the market had a reason to continue to build on the oversold rally. But there was hesitancy. Yes, the market moved higher, but there was hesitancy due to the upcoming FOMC meeting and the conference from Jerome Powell. And that leads us to In Focus tonight. What else? The enemy of the people, the Fed, led by Jerome Powell. This corrupt, evil organization, the Fed, is public enemy number one. The enemy of the people. And if you ever doubted that, you cannot deny that any longer, specifically after what we heard out of the mouth of Satan, Jerome Powell. But let's start with what the Fed decided in their FOMC meeting. Of course, as expected, this is not a surprise to anyone. We don't have any increase in interest rates. Interest rates steady, but tapering bond purchasing will happen quote unquote soon. Again, with the vagueness, with the shady wording and attitudes from the Federal Reserve not giving clear guidelines at all. What does soon mean? Soon, it means someday. But we all know it means never. Not gonna happen. Why? Because the Fed's main mandate is to prop up, preserve, protect, and inflate the assets of the wealthy, stocks and real estate. They will only taper and raise interest rates if they're forced to. So keep that thought in mind because we will revisit it later on because the Fed will indeed be forced. Not just to taper, but to increase interest rates whether they like it or not, and the outcome will be disastrous. The Fed says inflation is hotter than it thought, but sees prices cooling next year. Any guarantees here? Of course not. We just see we're eyeballing inflation, and we see it cooling next year, or maybe the year after, or the one after that. In other words, we have no clue what we're talking about. But while inflation is hotter, here's the other thing. The Fed also sees slightly slower economic growth. Pay attention now. So while inflation is going higher, this is their projection by the way, including food and energy, officials expect inflation to run at 4.2% this year. Ta-da! Up from 3.4% in June. So now the Fed is admitting that yes, inflation is going to rise higher, way higher than the bullshit estimate that we gave you before. Now they're giving us 4.2. And when the Fed says 4.2, it's actually going to be about 10%. The subsequent 2 years are expected to fall back to 2.2%, little changed from the June outlook. Again, any guarantees here, any explanation at all how inflation will fall down to 2.2% in the subsequent 2 years, or maybe 3, maybe 4, maybe 5, maybe we have no clue what we're doing right now. And I'm not sure about this one because this was on CNBC, and it was brought up on Twitter over and over and over again. I'm not sure about the validity of this one, but this is crazy. In another move, the Fed said it would double the level of purchases or repurchases its daily market operations to $160 billion from $80 billion. Vacuum Man is shitting his pants right now. The Fed's preferred inflation measure, the Personal Consumption Expenditure Index, aka the PCE, core PCE, less food and energy prices, because food and energy, not important at all. How about ex-food, energy, and oxygen? The index accelerated by 3.6% in July, the highest level in 30 years. And this is ex-food and energy prices. And therefore, this is the Fed's preferred measure of inflation because it downplays actual inflation in the economy. However, Powell has said repeatedly that he expects price pressures to subside as supply chain factors, goods shortages, and unusually high level of demand return to pre-pandemic levels. Really? The high levels of demand, Mr. Powell, are being caused due to the printing, the hurricane operation. What's stalking demand right now? With the pandemic raging, are oil prices rising higher because we have legitimate demand? Of course not. Oil prices are rising higher because we have so much liquidity in the system. Money has to chase something, and it is chasing commodities, including oil. Now pay attention here. The Fed admits that inflation will be higher than their previous expectations, but they also say that the pace of economic growth will be slightly less than we expected before. So inflation higher than expectations, economic growth less than expectations. What does that mean? Stagflation. Meanwhile, committee members think that U.S. economy will grow by 5.9% this year, a slight downshift from 3 months ago, when committee members were forecasting GDP growth of 7%, that could be partially offset by somewhat faster than expected growth in 2022. And by the way, the New York Fed pretty much stopped forecasting GDP altogether. The Atlanta Fed downgraded the GDP forecast from the bullshit 5.9 to 3.1 already. So this is all garbage. You know it, and I know it. The Fed is shitting their pants. They know that inflation will continue to grow higher, but the economy will slow down. We are about to head to the biggest stagflation storm since the 1970s. And I say that households must prepare for hyperinflation because this delusional madman, Jerome Powell, will let inflation rise higher and higher and higher. He is 100% convinced that inflation is rising higher due to supply chain bottlenecks and COVID, yada, yada, yada. But he dismisses any role that his reckless monetary policy is contributing to inflation. And we know that inflation is always has been a monetary phenomenon. But let's hear from the demon himself and what he said today, because remember, no tapering right now, but maybe soon. What are the threshold for tapering from the mouth of the demon himself? Number 1, substantial further progress in inflation. Number 2, substantial further progress in employment. And by the way, we don't have any definitions of what substantial further progress mean, but believe it or not, the quote-unquote journalists today did a pretty good job. So let's start by what Jerome sees in the inflation picture right now. Because remember, substantial further progress in inflation. Has it been met or not?
Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term.
Yeah, I wonder what's contributing to these supply chain bottlenecks, Mr. Powell.
These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year. While these supply effects are prominent for now, they will abate, and as they do, inflation is expected to drop back toward our longer run goal. And that's, I think, a reflection of the fact that the bottlenecks and shortages that we're seeing in the economy have really not begun to abate in a meaningful way yet. So those seem to be going to be with us at least for a few more months and perhaps into next year. So that suggests that inflation is going to be higher this year, and the inflation rates for next year and 2023 were also marked up, but just by a couple of tenths. Those are very modest overshoots. You're looking at 2.2 and 2.1, 2 years and 3 years out. These are very, very. I don't think that households are going to notice a couple of tenths of an overshoot. That just happens to be people's forecasts.
Okay, so he says that inflation will cool down someday. Trust us. With the same breath, he admits that inflation is still rising higher and it could continue to rise higher in the next few months all the way till next year. And he says that, oh, by the way, even if inflation goes higher, it's not a big deal. Households shouldn't be concerned about rising inflation, right? It's not like you have to eat meat every day. What's wrong with beans? Oh, shoot, beans price is also rising higher. Uh-oh. It's not like your rents went higher, right? I mean, where is inflation? Is it over here? Is it over there? I don't see an inflation here. It's not a big deal. Households should stop bitching and whining. Buck up. We need you to handle a little bit of taxation, taxation on the poor. That's what inflation really is, because we need to make our rich oligarchs a little richer by propping up the stock and real estate markets more and more and more. Once again, we have an organization whose sole purpose is to make the rich richer and make the poor poorer. Matter of fact, stealing from the poor, middle class, and the next generation, by the way, by racking up trillions and trillions and trillions of dollars of public debt, and we hand all of these trillions and trillions and trillions of dollars to the oligarchs, Jeff Bezos, and the likes. Again, if this is not the enemy of the people, public enemy number one, I don't know what is. But Powell admits that inflation is rising higher, and perhaps the substantial further progress threshold was already met when it comes to inflation. What about employment, though? Because this is the one that Powell is holding as a card to continue to delay tapering over and over and over again.
As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and job gains averaged 750,000 per month over the past 3 months. In August, however, job gains slowed markedly, with the slowdown concentrated in sectors most sensitive to the pandemic, including leisure and hospitality. The unemployment rate was 5.2% in August, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs and ongoing fears of the virus, appear to be weighing on employment growth. These factors should diminish with progress on containing the virus, leading to more rapid gains in employment.
Okay, so if the majority of the weakness in the jobs market came hand in hand with the rise in Delta cases, because the majority of the losses came from pandemic-sensitive sectors of the economy. And he also says that we are expecting a reversal and for the jobs market to recover as we recover from the Delta surge. Now, what does that mean? It means that Delta, the virus, is in charge of employment, regardless of how much coke the Fed prints. The Fed has been buying a minimum of $120 billion every month in bonds and mortgage-backed securities, including during the Delta surge. Yet the pace of recovery in jobs creation slowed down regardless of the printing. This is yet another evidence that there is no correlation at all. Zero correlation between the cocaine operation of buying $120 billion minimum of bonds and mortgage-backed securities every month and the pace of jobs creation. None at all. It's all about the virus. It's all about the pandemic. When cases go higher, the pace of hiring goes down. When cases go down, the pace of hiring goes higher. So why do we need to continue to buy $120 billion every single month, Mr. Powell, a minimum, when you admit that the virus is in charge of the employment picture? The only end result of this operation is increasing inflation higher, which is an added tax to the poor and middle class. And the only end result from all of this, besides stoking inflation higher, is propping up the equities and real estate markets to make the rich richer. I mean, what is full employment anyways? Because he pretends that he cares about us. I'm doing all of this, racking up trillions and trillions and trillions of dollars on public debt, propping up the stock and real estate markets to help you guys to create more jobs. Mr. Powell, we have more jobs available right now than people looking for jobs. And by the way, the demon himself admits that.
So you're right. We have a really, I'll call it a unique situation where by many measures the labor market is tight. And 11 million job openings, very widespread reports from employers all over the economy saying it's quite difficult to hire people, wages moving up and that kind of, so quite a tight labor market. So
see, now he's trying to bullshit because he knows that there is no reason at all not to taper. We have achieved substantial further progress and beyond in inflation and employment. So now he has to bullshit. And by the way, when somebody looks that way, in that right corner, they're lying. They're trying to imagine things that don't exist. Why? Because Jerome is trying to bullshit his way out of this question.
Our view, I think a widespread view a few months ago, was that several things were coming together in the fall, including kids back to school, which would lighten caregiving duties, including the expiration of extra unemployment benefits, and other things would come together to provide an increase in labor supply. And so we'd get out of this strange world where there are lots of unemployed people and a high unemployment rate, but a labor shortage. And so what happened was Delta happened. And you have this very sharp spike in Delta cases. And I think so that affects, for example, when schools are open 60% of the time, or when they're always at a threat of being closed because of Delta, the Delta variant, you might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that. So some of that may not have happened.
Here he is, admitting once again that the pace of employment and jobs creation has nothing to do at all with what he's doing, because the virus is in control. When we have cases rising higher, people don't want to take jobs and make these commitments. It's not just about the enhanced unemployment benefits. People are hesitant to take these jobs, making these commitments. We have no certainty, no clarity at all regarding the virus. Moms are not going back to the workforce because they have to take care of their kids if schools are not fully open. And with the lack of transparency from our public officials regarding the virus, who knows what the next variant will be and what will happen in the next few months, in the fall season, the flu season. It might get worse. If I'm a mom, why would I take a job right now when I have no clarity at all that my kids will be in school full time? Again, he admits that the weakness in the jobs market in August was due to the virus because the printing remained constant, yet the pace of jobs creation slowed down anyways. So once again, Mr. Powell, what is the use, what is the benefit of the cocaine operation of buying a minimum of $120 billion of bonds or mortgage-backed securities every month, besides stoking higher inflation and propping up bubbles, hyper bubbles in the equities and real estate markets? And guess what? The demon himself admits that the cocaine operation is no longer needed.
This is an approach that the committee will broadly support, and it will put us, having completed our taper sometime around the middle of next year, which seems appropriate. The asset purchases, as I mentioned, were very, very important in the early stages of the crisis. They were essential in restoring market function in the Treasury and other markets. Then, as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but it's time for us to begin to taper them. Their usefulness is much less as a tool than it was at the very beginning.
Okay, so why are you not tapering, Mr. Powell? What are you waiting for? Oh, I know. Substantial further progress.
To help us make sense of all those things as you sort through what substantial further progress looks like. That would be great.
Sure. So the test for beginning our taper is that we've achieved substantial further progress toward our goals of inflation and maximum employment. And for inflation, we appear to have achieved more than significant progress, substantial further progress. So that part of the test is achieved in my view and in the view of many others. So the question is really on the maximum employment test. So if you look at a good number of indicators, you will see that since last December, when we articulated the test, and the readings today, in many cases, more than half of the distance, for example, between the unemployment rate in December of 2020 and typical estimates of the natural rate, 50 or 60% of that road has been traveled. So that could be substantial further progress. Many on the committee feel that the substantial further progress test for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment, is all but met. And so once we've met those two tests, once the committee decides that they've met, and that could come as soon as the next meeting. That's the purpose of that language, is to put notice out that could come as soon as the next meeting. The committee will consider that test, and we'll also look at the broader environment at that time and make a decision whether to taper.
Okay, so there is consensus here among Fed members, at least some of them, that the substantial further progress test has been met on both inflation and employment. So why are you not tapering, Mr. Powell? Is this the advance warning for us? Or are you not going to taper at all because your main mandate is to preserve, prop up, and inflate the assets of the wealthy, stocks and real estate? I mean, we have more jobs open right now than people looking for work. So what is substantial further progress means? Will we have 100 million jobs open and nobody looking for a job? Perhaps when we have enough jobs for the Martians, when they stop by and visit, what would it take for you to taper, you criminal?
It's accumulated progress. So, for me, it wouldn't take a knockout, great, super strong employment report. It would take a reasonably good employment report for me to feel like that test is met. And others on the committee, many on the committee feel that the test is already met. Others want to see more progress, and we'll work it out as we go. But I would say that in my own thinking, the test is all but met. So I don't personally need to see a very strong employment report, but I'd like to see a decent employment report. I mean, it's not to be confused with the test for liftoff, which is so much higher.
And here he is, speaking from both sides of the mouth, dazed and confused, contradicting himself over and over and over again. Why? Because we know from reading the dot plots, we have Fed members not only ready for tapering, but they're ready for raising interest rates starting next year. We have at least 9 members in the Fed indicating that interest rates should rise higher next year. So now Powell says, yeah, I'm just bullshitting. We've already achieved substantial further progress and more when it comes to inflation and employment, meaning we're gonna taper if our overlords, the 1%, the Wall Streeters, allow us to. But rest assured, don't panic, don't scream, don't sell your stocks. Continue to put your blindfold on and buy. The casino is still hot because we will not raise interest rates because the substantial further progress test for raising interest rates is a lot more stringent than the substantial further progress for tapering. So perhaps the substantial further progress for raising interest rates is when inflation becomes hyperinflation, when we have Zimbabwe kind of inflation, and perhaps when the number of jobs open match the Fed's balance sheet's numbers. We're now at what, $8 trillion? Perhaps when we have 8 trillion jobs open, then we're going to raise interest rates. This is a recipe for disaster. You know it and I know it. Why? Because it will force them to raise interest rates abruptly. But before we talk about that, let's talk about the crimes of the Fed. Because if you're not aware, we have Fed presidents who got caught trading stocks and bonds, the same assets they've been propping up. This is the classic definition of insider trading. But you think Mr. Gensler over at this SEC gonna wake up from his coma and slap handcuffs on Jerome Powell and the other Fed criminals? Of course not. Why? Because these kind of criminals are above the law.
Prior to recent media reports, were you aware of the kind of security buying and selling that Presidents Kaplan and Rosengren were participating in last year? And I wonder if you thought those were appropriate.
So, no, I was not aware of the specifics of what they were doing. So let me just say a couple things about this subject. We understand very well that the trust of the American people is essential for us to effectively carry out our mission. And that's why I directed the Fed to begin a comprehensive review of the ethics rules around permissible financial holdings and activity by Fed officials.
So this is all garbage. It's bullshit. We have Jenna Smilik, whatever. She's a propagandist over at the New York Times. Perhaps Powell thought that I'm just going to bullshit her for a little while and she goes away, right? But now we have a male reporter, Steve Leisman. And all of a sudden, Leisman is doing some journalism. Have you noticed as of late, Steve Leisman have been asking the serious questions? Perhaps the Fed job is not going to happen, Steve, right? And now you're going to settle it to journalism.
Thank you. Thank you, Mr. Chairman. I want to follow up on Gene's question. The issue of ownership of these stocks and trades, do you think it's appropriate for Federal Reserve officials to be owning the same assets that the Federal Reserve is buying? Is that one of the modifications that you're looking at? And in that, you said yourself they don't clearly not seen as appropriate. In that, the Fed's code of conduct says Fed officials should avoid even the appearance of conflict. Do those trades, in fact, and holdings violate the Fed's code of conduct? Finally, do you have a timeline as to when you might be done with your review? Thank you, sir.
Don't have a timeline yet. We can start with that. So, well, let me address the muni question since that's in there. I personally owned municipal securities for many years, and in 2019 I froze that, meaning I'm holding all those securities, my wife and I, to maturity, and munis were always thought to be a pretty safe place for a Fed person to invest because, as you know, the lore was that the Fed would never buy municipal securities, so it was not an uncommon thing. And so then comes the COVID crisis, and I reversed that policy, and I did it without hesitating. And the reason was that the financial markets, and including the municipal financial market, were very much on the verge of collapse, and it was time to go, and we did. But we also checked with the Office of Government Ethics, who looked carefully at it and said that I didn't have a conflict.
Yeah, I checked with my subordinates, the ones that I can fire, about my ethics violations, and they said, hey, boss, you're not doing anything wrong at all. Please don't fire us. And I trusted them. They said I'm not doing any crimes. Case closed. But watch out for Steve Leisman, because Leisman is not happy. He got some sour grapes here, big ones, that he's not getting this job at the Fed. And he's taking it out on Jerome Powell by asking legitimate questions.
I'm sorry, Chair Powell, I just want to follow up. You said I was right. When you said right about that the Federal Reserve should not own the same assets they're buying?
I think that's a reasonable thing. Yeah, and of course, for the most part, we don't. I mean, it was a real coincidence. I happened to pre-own these munis. They were bought many years ago, actually. And so we started buying munis as part of the municipal liquidity facility. So it was really not it just was an unforeseen event, and I couldn't sell them. So what I did was I just held them, checked with the ethics people, and went ahead. So, but it's a general principle. Yeah, that makes a lot of sense.
Yeah, that makes a lot of sense. We're not going to do it again, folks. We committed crimes that regular people would go to jail for, but we're not going to go to jail because we're above the law. So we're just going to look at it and study it, analyze it, consider it, and then when the public outrage is over, we're going to go back and buy stocks and bonds again. But watch out here, because the quote-unquote journalists were doing their jobs today, believe it or not. And here we have another one who brought up the point about Kaplan and Rosengren trading stocks, individual stocks, by the way, which is 100% a violation, even to the Fed's loose rules. And he's saying, wait a minute here, you have known about this all along. There is no way you're not aware about this, because Fed Governor Brain did. She already done the thorough job, quote unquote, with Kaplan and Rosengren, Barkin, and who knows who else. So you guys must have known already that Kaplan is trading stocks.
Process earlier this year, and Governor Brainerd described it as a rigorous process at the time. So I want to know, did anybody at the board level know about the stock trading activity? And going forward, do you still have confidence in the Dallas and Boston Fed bank presidents to do their job?
So these, I don't need to tell you, people file these reports annually, and I think they were just quite recently filed for 2020. So I don't have any reason to think people at the board would have known about particular trading that's going on. They will see that there are people at the Fed who see that. See the trading reports when they're annually filed. In terms of having confidence in that sort of thing, I think no one is happy. No one on the FOMC is happy to be in this situation, to be having these questions raised. It's something we take very, very seriously. This is an important moment for the Fed, and I'm determined that we will rise to the moment and handle it in ways that will stand up over time. I'm very reluctant to get ahead of the process and speculate, though, about different things. And when we have things to announce, we'll go ahead and do that. But that's really what I have for today.
So one small follow-up. I mean, I know that you didn't have the 2020 forms in hand, but you would have had past year forms in hand. And at least in the case of like the Dallas disclosure forms, similar trading activity was shown in years past. So that in theory could have been something that came up in the renomination process.
So that's a good question. So.
Yeah, that's a good question. Don't repeat it, please. You got me, you son of a bitch. Should I call you boss to get you fired? Stop asking these kind of questions. And folks, here it is. This is the enemy of the people. This organization, the Federal Reserve, has achieved nothing at all but creating bubbles, hyper bubbles, in the equities and real estate markets, leaving us with a massive public debt and a higher inflation. Inflation that continues to grow out of control. But do we have any tangible gains when it comes to employment, increasing the standard of living, or increasing purchasing power? For regular people, of course not. On the contrary, the Fed's policies reduce purchasing power, reduce the standard of living, and choke the poor and the middle class. We're getting killed here with rents rising higher, used car prices rising higher, food prices rising higher, utilities prices rising higher. But this asshole, this criminal, says, where is the problem? I don't see any problem here. We're just trying to help. Again, the enemy of the people. It's clear right now. You cannot deny the facts. Yes, their co-cooperation and the manipulation of assets in the equities and real estate markets benefit us to a certain degree because we happen to have retirement accounts, we happen to have portfolios in the stock market, and we happen to have and own real estate. Some of us, not all of us, but some of us are homeowners. But again, when our home prices go out of whack, we're going to pay more taxes on that. In addition, our ownership in the equities market is pretty much nothing. It amounts to nothing. 99% of ownership in the stock market are held by the 1%, the billionaires, the oligarchs. And the only achievement from this pandemic isn't saving small businesses. We know small businesses are struggling right now. They're looking for aid. The achievement is not helping the poor and middle class or creating jobs. The only achievement is making the rich richer by the tune of over $10 trillion. So when you wonder, where did the money go? The Fed's balance sheet grew by trillions and trillions and trillions of dollars, meaning that we have trillions and trillions and trillions of dollars added to the public debt that the next generation of Americans will have to deal with, your kids and grandkids. But where did the money go? Did it go in infrastructure spending? No. Did it go in helping small businesses? No. Did it go in helping the poor, middle class, solving homelessness? Of course not. It went into the coffers of corporate America to use these trillions and trillions of dollars for share buybacks to prop up stocks higher and benefit the insiders, corporate executives, and the billionaires holding these stocks. When they dump, cashing in these trillions and trillions of dollars. Fake money printed out of thin air becomes real money, and they use the real money to scoop up assets, real assets. Single-family homes, millions of acres of land, and farmlands specifically. This is, once again, the crime of the century. But do we have anybody paying attention at all? Do you hear this kind of news on CNN, Fox, anything? Not at all. The majority of Americans are not even aware that we have Fed presidents caught trading stocks and bonds, while at the same time, their policies were propping up these same assets higher. Where's the outrage? We don't have outrage. Why? Because we don't have media. The media is not truthful at all. The media has certain agenda, and this agenda is not to serve regular folks. It's to serve the propaganda purposes for corporate America and the billionaires. And this is the moral of the story, by the way. We have people assuming that the Fed will not tighten at all. And I agree, because their mandate is to prop up, preserve, and inflate the assets of the wealthy, equities, and real estate. But the risk is that this reckless policy will implode on all of our faces. When this reckless policy implodes, everybody will suffer the damage and the pain, specifically the poor and the middle class. The take here is that inflation will rage out of control, and this will force the Fed at some point, perhaps sooner than many expect, not just to taper, but to raise interest rates abruptly. And we know, historically speaking, that market crashes and economic crashes happened when the Fed suddenly have to raise interest rates. And we get a little taste of that, by the way, back in 2018. Can you imagine what will happen to the stock market if the Fed starts to raise interest rates abruptly, with all of the debt that we have, with all the hyper bubble inflation and valuations that we have right now? And even bankster Jamie Dimon agrees with me. He sees the Fed being forced into a sharp move next year, and this will be historic. If it happens, you will see a crash in the stock market like you have never seen before, bigger than 1929. You will see a massive crash in the real estate market like you have never seen before, bigger than 2007, 2008. And again, who will end up holding the bag? The answer is the poor and the middle class. The rich, they're already taken care of. They have billions and billions of dollars. The fake money became real money, and now they have real assets. They will be actually praying, hoping for a crash so they can scoop up more properties, more assets for a penny. on the dollar. Isn't this the enemy of the people? Anyhow, folks, we have to move on here and cover the market's performance today. And here we go. The Dow Industrial Average closing in the green by 338.48 points, or a gain of 1%. The Nasdaq closing in the green by 150.45 points, or a gain of 1.02%. The S&P 500 also closing in the green by 41.45 points, or a gain of 0.95%. And what about the sector's performance today? Every single sector of the market closed in the green, the tide that lifted all boats, the oversold bounce continues, and on top of that, we have the Fed helping the market higher for now. Pay attention. For now. But once you dig into the details, I don't think the market will be happy. Anyhow, closing at number 1 and capturing the gold medal, energy. The number 2 for the bronze. Number 2 for the silver, technology. And number 3 for the bronze, financials. We're not going to shame any sector here. Every sector of the market pretty much closed in the green today. What about the advance to decline ratios? The NYSE, 80% advancing versus 18% declining. For the Nasdaq, 69% advancing versus 28% declining. Now, when we saw 16% advancing in the NYSE, we call the bottom. When we see 80% advancing in the NYSE, we call a top, at least in the interim, meaning we are expecting a pullback from this point on. Moving on to futures, rebound day, inflation rages higher, and it will continue to go higher and higher and higher. Massive gains for crude oil prices, the WTI up over 2% today. Likewise, when it comes to grains, massive gains for our favorite oats, up over 4.5% today, followed by wheat, soybean oil, corn, canola, soybean, rough rice, all closing in the green, and then we have soybean meal futures closing on the flat line. What about meats? What's going on here? Modest gains for feeder and live cattle futures. Meanwhile, modest declines for lean hogs futures. What about metals? Rebound day once again for palladium, platinum, massive gains. And even Dr. Copper is finally joining the rebound by over 2% today. We have modest gains for silver futures, but gold is not happy today at all. And gold will not be happy for a long time, by the way, because while the Fed says we're not going to taper, we did not taper, rest assured everything is going to be fine. The dollar index says don't trust the son of a bitch Jerome Powell. He's lying. He will be forced to taper. And therefore, the dollar index shooting up higher by the end of the day and gold collapsing. What about softs? We have gains for lumber, the transitory one, remember? Followed by sugar, cocoa, cotton, coffee, all closing in the green. Meanwhile, we have losses of more than 1% for OJ futures. Let them eat OJ. Moving on to the big casino, the options market. What's going on here? At number 1, per usual, the hottest table in the casino, Apple. But watch out for the volume here. We have a lack of conviction in the bounce higher in the market so far. We're not seeing options traders making massive bets here, buying calls. Matter of fact, the put to call ratio is tilting toward puts. Likewise, as you will see in the unusual activities, the majority of activities are a few cents here and there. Trades out of the money, 5 cents a piece, 10 cents a piece, 20 cents a piece. Why? They're wild shots. I participated in some of those, by the way. You're expecting a sharp move higher one way or the other, but you have lack of conviction. You're not committing serious amount of money in options trades right now because we have no clarity at all, even after the conference from Jerome Powell. If anything, he confused the market even more. But anyhow, Apple at number 1 with about 925,000 contracts. About 63% of those were calls. At number 2, Tesla, the souffle, with about 700,000 contracts. About 51% of those were calls. At number 3, the biggest loser today, Facebook, with about 570,000 contracts. About 60% of those were calls. Moving on to the unusual activities that we got in the casino today. Again, notice the ask and last prices. We're talking about few cents here and there. You're not seeing trades over $1. Again, this is lack of conviction. We're hoping for wild shots. That's all there is. Let's start with the ticker NLY. And this is for Annaly Capital Management, whatever. Significant, unusual activities for this name today. Somebody knows something. Somebody got tomorrow's newspaper today. They're buying calls, the $10 calls with the expiration date of November 19, with expectations that the name will pop higher by more than 13%. They paid about $8 a piece to enter. this trade. All in all, spending about $350,000. What about the trade for the ticker DKNG, DraftKings? Now, the implied volatility in this name dropped significantly, meaning we have an opportunity here for a sharp move in the options market in DraftKings. Remember, I called the top in Lucid yesterday, and the opportunity now for Lucid is gone. Why? The premiums are too high, but the premiums remain low for DraftKings. But perhaps this will change soon because we have a massive move to come, at least according to this trade, because they're buying the 57 calls with the expiration date of October 1st with expectations that the name will pop higher by more than 8%. They paid about 45 cents a piece to enter this trade. All in all, spending about $500,000. What about the trade for the ticker TROX, Tronx? They're betting for more upside here, and the stock moved higher midday as this trade was taking place. And here we have a bet, the 25 calls for the expiration date of December 17th, that the name will pop higher by over 5% by then. They paid about $1.50 a piece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker MRIN, Marine Software? The name blasting higher today. On the news that they have a deal with Google once again, who cares? The name popped higher. Somebody's calling for a top. They're buying these 7.5 puts with the expiration date of October 15th, with expectations that the name will drop by more than 19% by then. They paid about $1.15 a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker MGM? They're betting for more downside here. MGM got involved with this whole Macau thing, the crackdown, Las Vegas Sands down big, Wynn Resorts down big. All of a sudden, MGM is down along with them. And this is quite humorous, by the way, for a person who lived and worked in Las Vegas in the casino industry, because MGM used to be the butt of jokes, the garbage company on the strip. Meanwhile, the Las Vegas Sands and Wynn, these are the high-class resorts, the best companies on the strip. And now the whole picture went 180. The garbage companies, Las Vegas Sands and Wynn, and MGM all of a sudden is the one leading. I wonder why, by the way. Who was the analyst who gave MGM the online gambling casino idea years back? I wonder who. Anyhow, they're betting for more declines to come here for MGM by buying the 39 puts with the expiration date of October 22nd. And the expectations are for MGM to drop by more than 9% by then, and they paid about 80 cents a piece to enter this trade. All in all, spending about $650,000. Continuing with interesting trades. What about the trade for the ticker TSLA, Tesla? They're betting for downside here, but the name remains relentless. One of the best performers in the NASDAQ and the S&P 500 so far, bucking the weakness in the overall market. But they're taking another shot here, the bears, by buying the 685 puts with the expiration date October 1st, with expectations that Tesla will drop by more than 9% by then. They paid about $4.50 a piece to enter this trade. All in all, spending about $2.5 million. What about the trade for the ticker GM, General Motors? The name has been under the hammer, getting squashed, and the reason is the recalls for the Bolt, Volt, whatever it is. But again, we have more optimism here. The new Cadillac, the electric one, is coming out, and perhaps we have a bottom in GM and more upside from this point on, because remember, the government will give you about $12,000 in credits if you buy an EV from GM and Ford, the union companies, not Teslas, Toyotas, and the rest. My pick is Ford, but GM is good too. I used to hold GM last year. Anyhow, they're buying the 45 calls with the expiration date of October 29th, with the expectations that the name will pop higher by more than 6% by then. They paid about $1.20 a piece to enter this trade. All in all, spending about $500,000. Lastly, what about the trade for the ticker ONTX on Conva, whatever the hell it is, Therapeutics? We noticed some unusual activities on this name yesterday. Traders over at Twitter were talking about this name, and again, the name popped higher, building on the gains that we got yesterday. And now we have somebody betting for more gains to come by buying the 7.5 calls with the expiration date October 15th, with expectations that the name will pop higher by more than 19% by then. They paid about 85 cents a piece to enter this trade. All in all, spending about $4 $100,000. Moving on to the heat map analysis. What's going on here? A more inclusive rally. I like this rally better than yesterday's rally because we have the cyclicals, the offensive sectors of the market rallying. Banks, industrials, oil, materials, restaurants, hotels, cruises, the value names like Ford, for example, all rallying higher, including chips, by the way, another offensive sector of the market. And therefore, I like this one better than yesterday's rally. But I'm not sure if this is sustainable for now. We need a confirmation because this could be an oversold bounce. The cyclical trade, when we talk about oil, but specifically materials, are down big. We're seeing massive oversold conditions here in steel, aluminum, copper, so the rebound could be an oversold bounce. I need to see a confirmation because I'm not sure that the market will like the conference from Jerome Powell once it digests what the demon said. But we have weakness here from Adobe. This is related to earnings. And then we have Facebook, by the way, down about 4%. Facebook has a lot of problems. We had CRM, Salesforce CEO, Mark Benioff, attacking Facebook yesterday. On top of that, we have the bombshell report from the Wall Street Journal about how abusive Instagram is to teenagers. And then on top of that, we have the spying issues. Facebook caught spying on WhatsApp. We have multiple issues here with the company of Zucchiniberg. And then we have perhaps the most important one that you have to pay attention to, the drops in UPS, but specifically FedEx, down about 10% today. Every single one of you right now should listen to the conference call from FedEx, because in the call, they show you without a doubt that this inflation crisis and the labor shortage is killing them. And this will be contagious, by the way, not just for FedEx, but for every single company. And I would have loved if some of the journalists today asked Powell about the FedEx earnings call. What do you make, Mr. Powell, of FedEx executives saying that this is not going to get better at all, that the labor shortage is killing us? Of course, Powell's going to say these are all transitory factors. They're going to go away soon. Moving on to charts, starting with the 30 minutes chart of the SPY. What's going on here? The oversold rebound continues. We had a sharp drop, oversold conditions, rebounding based on those technicals, and then consolidating for a little while before the FOMC meeting, then moving higher, and now consolidating once again. Why? Debating. Where should we go next? Can we continue to move higher here on oversold bounces alone? Or what did Jerome say today? Because it wasn't so good for the market, in my opinion. The resistance remains 438. The support remains 434. And we have a gap. The SPY could rally all the way to the gap, and we'll see what happens from there. But look at the MACD indicator, for example, from a 30 minutes perspective. We had the oversold conditions, extreme ones, and we're rebounding and moving higher based on the oversold bounce. Now the MACD is normalizing once again, but it is curling down, indicating weakness. What does that mean? We should be expecting a pullback starting tomorrow. Moving on to the daily chart for the continuous contract on the SPY. Again, not a good looking chart regardless of the bounce, the rebound higher. The momentum indicators remain weak and the chart is struggling to break above 4,384.5. The assumption is it's going to go back and forth for a little while, forming the bear flag formation, and then it will flush down. Therefore, the bulls must push the market higher, closer back to the trend line by the end of the week. What you don't want to see as a bull here is this zigzag kind of action, back and forth, under 4,384.5, because this will mean the bear flag is forming and we have another leg down. What about the Qs? 30 minutes chart, again, a similar chart to the SPY, nothing is going on here. We had the wedge consolidation. My bet was that the wedge consolidation will break to the downside, but the market decided to go higher based on the Evergrande optimism, based on the FOMC optimism. It doesn't matter. The technicals matter the most here in this bounce because we're rallying on an oversold condition. So the market moves higher, recapturing 369 for support. And now we have another period, as you can see, from these massive candles going back and forth in another consolidation. Why? Looking around, evaluating the conditions. Can we rally higher or should we pull back again? So there is a lot of thinking here, a lot of debate going on in the market as we speak right now. My hunch is what got us down is not over yet, and we will see more weakness to come. What about the daily chart for the continuous contract in the Nasdaq? Faring a little better than the SPY because it is trading above 15,000 and the momentum indicators are strengthening slightly. But again, what got us down here is not over yet, and it will not be soothed by an $18 billion injection the Chinese banks for now. That's just a band-aid, and we will revisit the Evergrande problem once again. On top of that, the Fed spoke with both sides of the mouth. On one side, yes, we met the tapering conditions, but we're not tapering right now. On the other side, even if we taper, we're not going to raise interest rates. And the market will get to a point where, wait a minute here, this guy has been saying transitory over and over and over again. But if he's not going to taper and he's not going to allow interest rates to normalize, then he will be forced to do so. Forget about retail. They're not going to think like that. I don't expect them to. But the institutionals, and you heard it from Jamie Dimon, by the way, they're going to start to think that way, that the Fed is too late and this market should not be trading at these levels, because the Fed will be forced to taper and forced to raise interest rates. The line in the sand remains 15,000 in this chart. By the way, here is the NDX daily chart for the big NASDAQ. And notice that every time we have broken a trend, the chart consolidated at least for a few days. And we're talking anything from 48 days to 20 days. You have to consolidate for a little while to absorb the shock from breaking the trend. Of course, we have one major trend, but we also have many trends within the major trend. Every time these many trends were broken in a bull market, the chart has to consolidate for a little while and then move its way higher. So anybody who anticipates or expects that the market will just bounce higher in a vertical move, a V-shaped recovery, is not following history. In my opinion, this will not be a rebound once again, all-time highs, and here we go. You're going to have to consolidate for a little while, if not go lower. Moving on to the IWM, the Russell 2000. This chart looks a lot better than the SPY and the NASDAQ. Why? Because the gap from Monday is already closed. The Russell 2000 is already trading at the same levels from last week. And we have a lot of technical analysts, by the way, who believe that the IWM, the Russell 2000, is a leading indicator. And if the IWM already made it back to the same levels from last week, then the SPY and the NASDAQ will make it too. You have to represent both cases here. There is a bullish argument for the market to move higher, but it's not strong, at least not yet. The resistance remains 223, the support remains 218. And by the way, why do I say that the bull argument is not strong yet? Because the assumption for now is that this bounce that we saw in the market off the lows were due to technical reasons, the oversold bounce. Will it hold after the oversold conditions already resolved? We'll see. But perhaps here's your leading indicator, the dollar index, the DXY. While the stock market traded higher, celebrating what came out of the mouth of the demon, the DXY is saying he's lying and he will be forced to taper because the DXY moved higher. It went down actually after the minutes were revealed, but as soon as the demon started talking, the dollar index shot up higher. Why? Because the devil is always in the details. And when you hear the conference, you realize that Powell is dazed and confused. He already met his threshold in substantial further progress, but he's not tapering right now because either he's not interested in tapering at all, he did not get the order to taper, or today was the advance warning, and in November the Fed will start tapering. This is at least what the dollar index is saying today. And by the way, this is a breakout, meaning that we have higher highs to come in the US dollar. And by understanding that, your trading strategy will become better. For example, remember when we talked in the heat map analysis that I'm not buying the action that we saw today, even though it was a lot better than the rally yesterday? Well, if materials are bouncing higher today, while the dollar also shooting up higher, that tells me that the rally we saw in the cyclical side of the market today is not sustainable. Matter of fact, if you look at a stock like Freeport-McMoRan, for example, the ticker FCX, it closed at the lows of the day as the dollar continued to shoot higher. So if the dollar is about to spike higher again, forget about the rally that we got today in the market, it will reverse. And when we talk about the dollar rising higher, you got to talk about gold. We have semi-dead cat bounce here in gold, but my belief is that gold will flush down again. Gold will not be able to hold again if the dollar continues to rise. And remember, we say that gold is the mature guy in the room. Yes, copper popped higher, platinum popped higher, but the mature guy in the room was down today. Why? Because the mature guy in the room is saying the pop was due to oversold bounces, but the rally is not sustainable in metals so long as the dollar continues to rise higher. What about yields? What's going on here in the bond market? No resolution at all. Perhaps we have some digestion here of what will happen next. Powell is not tapering for now, and he says that raising interest rates will not happen, not anytime soon, because the substantial further progress requirement for raising interest rates are much stringent. On the other hand, we have the dot plots, other Fed members saying that raising interest rates should happen as soon as next year. So it is a battlefield right now in the bond market, and I don't want to be involved in this battlefield, in any side, at least for now, because this will be volatile kind of battle. You will get data that inflation is rising higher. You will get other data that growth is slowing down. Thus, the stagflation argument. And the bond market will go back and forth, back and forth. I will leave it. I'll not engage with it. Yes, banks were rallying higher today, but yields did not rally higher. Another sign that this rally we got today is not sustainable. Here's a chart for the TLT moving higher from a weekly perspective, way above 149. And perhaps we're having a breakout right now because the consolidation was a gathering of energy. It's a process in the span of weeks, gathering energy for the move higher or lower. And so far, it appears that the move will be higher in the TLT. What about the VIX? Perhaps the most accurate leading indicator, the 4 hours chart. We talked about the MACD topping along with the RSI. The moment you saw the red candles on the histogram, you knew right away that the SPY will rally higher. Now we have the VIX closing a gap, almost, still trading above 20. The question is, will it curl back higher and build on the gains toward the end of the week, or was this pop all there is? And if that is the case, then the SPY bottomed already and it will continue to rally higher. Watch the MACD indicator from 4 hours perspective. If it continues to drop, then assume that the SPY will close the gap and perhaps beyond. But if the VIX curls back higher, watch out because we will see significant pain in the indices, but specifically the SPY. What about Apple? What's going on here? Reclaiming 145, perhaps closing the gap, but we don't have any confirmation here. The chart will revisit the gap. It will close the gap, but most importantly, will it continue to build on the gains, or will it do a 180 after closing the gap and we continue to go down? My assumption is that we will see bounces like we saw today, but the chart will continue to go down to revisit the target of the channel, the lower end of the channel, which will be around 15% correction from the top. Tesla, what's going on here? The bull flag is playing out, and now the chart's trading above 742. But we have another gap around 757. And again, every chart right now is acting the same way. We have a gap in the SPY, the Qs, Apple, and the assumption is if the rally continues, the gap will be the target for now. If you believe in the Russell 2000 theory, then the IWM already closed the gap. And that means the SPY, the Qs, and everybody else, Apple, Tesla, will close the gap too. I don't happen to believe in this theory that the IWM is a leading indicator, but if you do have at it, your assumption should be all of these charts will close the gap too. The support remains at 742. Moving on to BTC, tulips. What's going on here? We had a scare yesterday, it dropped below 42,000, and this was due to a sell-off in the Asian market. There was a little bit of panic here overnight. But when the news came out that the Chinese government is injecting over $18 billion into the banking system, those fears were soothed, at least for now. But again, this is a technical breakout. Once you dip below 42,000 and recover, you're going to have to go down and retest it again. Will it hold the retest? We'll see. My assumption is it will not. What about AMC? What's going on here? A rebound day along with the market. We have some news here that AMC's CEO is exploring ways for the apes to pay using Dogecoin, which by the way sent Doge prices higher. I'd love to buy a beer for AMC's CEO Adam Aron. And if we get him drunk enough, he will say, you know what, this company is done. It's toast. All what I'm trying to do here is to milk the mania as much as I can. And he's doing a good job, by the way. Using buzzwords, we will use cryptos, Doge, NFTs, garbage, whatever you guys want. Just please keep the stock price higher because at some point, me and my buddies, the insiders, when we get the signal for sure that you guys are about to get slaughtered, the apes, then the act of appeasing and baby talking to you guys, we're not going to do that anymore. We're just going to dump stocks, cash in, and who cares what happens to the company? It goes bankrupt, restructuring, you guys deal with it. For now, the test remains 42.5 for resistance. Can you climb above that by the end of the week? Or the next natural destination will be 32 for support. Once that is tested, it will fail. Goodbye, AMC. You gotta close the week above 42.5. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have, per usual, the weekly jobless claims, and Powell says, I want to see some improvement. I don't want to see blockbuster reports. So perhaps a number below 300,000 claims. Again, it's good news, but for now, good news is bad news for the market because good news will lead the Fed closer to tapering and raising interest rates. Market bulls should be cheering for the next variant, because Delta is already peaking, and if Delta peaks and we have good news once again, this is bad news for the stock market because it removes the Coke, the need for the Coke. So we should be cheering for the next variant, whatever name they will give it. We also have the manufacturing and services PMIs. These will be important regarding the picture of inflation and supply chain bottlenecks. But most importantly, what's going on with the labor shortage? Because we have FedEx. Will the services and manufacturing PMI confirm that they're having trouble with the labor shortage? We'll see. An important day already behind us, and now it's up to the market to decide. Do we continue to party until tapering actually happens, or do we anticipate that ahead of time? If we continue to party on the premise that Powell did not taper and did not announce tapering, and even though he admits that the substantial further progress requirement already met in both inflation and employment, yet he's not going to taper anyway, then the man will not taper. He's not interested in tapering. Perhaps he believes that inflation will subside and the labor market will recover after Delta, and he doesn't need to taper. He doesn't need to raise interest rates at all. It's delusional, but it could rally the market for now. However, if the market decides and reads that perhaps Powell is losing control and he will be forced to taper, forced to raise interest rates, then the market will drop again. What is the mature thinking right now? The mature thinking is he will be forced to taper. But again, are market participants so far mature? Of course not. They need any excuse to rally higher. The action we're about to get tomorrow will be a confirmation whether we have the per usual participant in the market leading on the front seat, or will the mature voice of reason grabs the steering wheel and says, you know what, we need to pause here for a little while and flush out some of the hyper bullish sentiment out of the market. We'll see. Folks, this is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.